Hey everyone, welcome back to Corporate Decoder, the place where we decode the confusing world of corporate finance with a smirk and a whole lot of layman's terms. Today we're diving into Azitra Incorporated's latest filing, a report that shows a company trying to raise some serious cash. So let's see if they're pulling off a clever trick or just trying to stay afloat. Before we dive in, if you like getting these simplified breakdowns of complex financial documents so you can make smarter investment decisions, consider hitting that subscribe button. We also have a fantastic community Discord channel linked in the description below where we discuss these filings and more. Alright, let's get straight into what Azitra Incorporated, the company we're looking at, has been up to. This report is all about a recent deal they made to get more money. So basically, on the 24th of November of 2025, Azitra made a deal, a securities purchase agreement they called it. They were selling shares of their common stock and some warrants. They agreed to sell a bunch of stock and some other things called warrants. Warrants are like options to buy stock later at a certain price. These warrants could let people buy more than 4 million additional shares down the line. The price for this deal was pretty low, just 32 cents per S-share, or for these special pre-funded warrants, which work a bit like buying stock right away. All in all, this offering brought in about $1.5 million before they paid any fees or expenses. This whole money-raising event wrapped up pretty quickly, just a day after it was announced in terms of closing. Now, after this deal, Azitra made a promise. For 60 days, they are restricted from issuing any more stock or anything that can be easily turned into stock. This is a pretty common thing in these types of deals to prevent dilution for the new investors. And that is not all for a long time. Until February of 2027, this investor who bought in has the right to buy up to 25% of any future stock sales Azitra might do. This is to protect their investment and give them a chance to keep their stake from getting too diluted. There is also a catch with exercising those warrants. Any investor buying these warrants can't own more than 4.99% of the company's stock after they exercise. This is a way to keep any single investor from gaining too much control too quickly. They can even ask to raise that limit to 9.99%, but they have to tell Azitra first. To get this deal done, Azitra also hired someone to help them out, a placement agent. Think of them as a broker who finds buyers for these private stock sales. That agent was Maxim Group LLC. They are the sole agent, which means Azitra gave them the exclusive right to find these investors. As payment for their services, Azitra has to give Maxim Group a fee of 7% of the money raised. So that is about $105,000 out of the $1.5 million. On top of that, Azitra also had to give the placement agent warrants to buy another 187,500 shares of their stock. That is potentially another big chunk of shares they'll have to issue later. They also agreed to cover Maxim Group's expenses, like legal fees, up to $50,000. Then there is this thing called a registration rights agreement. This is pretty important for the investors. What this means is Azitra has promised to file paperwork with the Securities and Exchange Commission, or SEC, within 20 days. This paperwork is to allow the investors who just bought shares to be able to sell them later on the open market. They need to get this registration statement approved by the CC within 60 days. Or maybe longer if the CC wants to do a deep dive. This section just confirms that the shares were sold without being registered with the SEC in the first place. That is why they need that registration rights agreement we just talked about. And another new section, Azitra announced this offering with a press release on the same day they made the deal. This press release is filed as an exhibit with the rest of this report. Finally, the report is signed off by the big cheese himself, Francisco D. Salva, the Chief Executive Officer of Azitra Incorporated, confirming all this information is accurate to the best of his knowledge. Now let's wrap this up with my tape. Azitra Incorporated is in a classic fundraising situation typical for many companies, especially smaller ones, looking to grow or simply keep the lights on. They've managed to secure about $1.5 million, which is a decent chunk of change, but it came at a cost. They sold shares at a discount and gave out warrants to both the investors and the placement agent. This means that in the future, their stock could be heavily diluted as these warrants get exercised. The registration rights agreement is a positive for the investors as it paves the way for them to easily sell their shares later, but it does mean more administrative work for Azitra. The biggest risk here is dilution. If Azitra doesn't perform well and the stock price stays low, a lot of future shares could be issued for very little money, significantly decreasing the value for existing shareholders. The company's direction seems to be focused on immediate capital infusion rather than long-term organic growth that doesn't involve extensive share issuance right now. A key opportunity for them would be to use this capital effectively to drive significant growth that justifies the dilution. The clear conclusion is that this is a company actively seeking capital and managing its ownership structure to do so. They're betting that the future growth will outweigh the current dilution. What is your take on Azitra's latest move? Do you think this fundraising strategy will pay off for them in the long run, or is the dilution too much of a concern? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give it a like and subscribe for more of these deep dives. And don't forget to join our Discord community linked in the description for more in-depth discussions. Thanks for watching. See you next time on Corporate Decoder.